Thanks, Stanford. Good afternoon all. Welcome to the Q3FY18 earnings conference call of Can Fin Homes Limited. To discuss the financial performance of Can Fin Homes and to address your queries, we have with us today Mr. S.K. Hooda, Managing Director of Can Fin Homes, and Mr. Atanu Bagchi, CFO and DGM. I would now like to hand over the call to Mr. Hooda for his opening comments.
Yeah. Thank you, sir. Good afternoon and Happy New Year to all of you. Happy Makar Sankranti. Now that FY18, the first 3 quarters are behind us, I'd like to say that the first 3 quarters of current year, this had some impact of the lag impact of demonetization, RERA, GST. There are a lot of activity during the calendar year 2017. All those are behind us. One very positive is the housing market is looking up, as reflected in our the sanctions, new approvals, as well as the disbursements. For your company, the sanctions have gone up for Q3 by 14% year-on-year. That is, Q3 of current year has seen a 14% increase in its new approvals compared to the Q3 numbers of last year. The disbursements have gone up by 9.5% compared to last year. And these numbers, if you compare with Q2, both sanction as well as disbursement were up by 4% compared to Q2 of previous year. And Q1 had a very flat growth. It was marginally negative compared to the last year's sanction levels. So Q1 of FY17 and Q1 of FY18, if you compare, we were just matching up the new approvals. From that level, we grew to 4% and now to 14%. This is a very strong positive. We see revival of the housing loan market and the housing sector as a whole. When it comes to the loan book growth, loan book has grown by 19% year-on-year. And for the first time, Can Fin Homes has crossed the milestone of 15,000 crore loan book mark. Coming to the earnings numbers for Q3, the income went up by 13% and the expenditure were contained at around 9%. When it comes to the NIA growth was 16%. Operating profit grew by 24% and the PAT has grown by 34%. There again, consistently quarter-on-quarter from Q1 71 crore to Q2 75 crore. Now we have crossed the 80 crore mark. So these numbers are all-time high for the company for any quarter. And if you compare for the 3 quarters put together, we have clocked the PAT number of 226.31 crore, which is almost equivalent to near the last full year's profit numbers. Coming to the ratios, the earning ratios and the margins, we have been in a position to consistently maintain the margins above 3.5% despite the Q3 witnessing and the bond yields hardening, going upward, and some impact of the yields falling because of the competition in the market. We are very happy that consistently, maybe it is for the 6th quarter that we are holding on to this 3.5 level and 3.5 plus the level of margins and NIM. For the in terms of the earnings ratios, one more is very strong positive is after March 2017, first time the company came above, posted a ROA of more than 2%, EPS of ROE of around above 20%, close to 23, 24, 25% in those ranges. We have been in a position to hold on to all those. Our capital adequacy is going on improving. It is at 19.16% now, and Tier 1 is close to 17. Average business per branch has grown to something like 106, 107 crore, and per employee business has grown to 24 crore. Asset quality front, current year has witnessed some impact in terms of the delinquencies. That is the market trend overall we have witnessed. And as a strategic move, even last quarter earnings call, I had told that there is a strategic shift in our focus towards the credit monitoring and recovery policy. As all of you will appreciate, for Can Fin, we have never compromised with asset quality when it comes to the growth numbers. So asset quality is of paramount importance for the company when it comes to the new approvals and the acquisition of the new loans. So we have stuck onto our fundamentals of the company, that we will not compromise in terms of asset quality. So as a prudent measure, you can treat it as sort of, it's a strategic shift that we had taken from Q1 itself. Q1, I had disclosed that we have marked some 180 accounts for recovery under SARFAESI. Total during the 3 quarters for 350 plus accounts, we have invoked SARFAESI, amounting to more than 50 crores. And one very strong positive is the results are very good. Almost 170, 175 accounts have been regularized through this route. We have brought it down, those delinquency levels in those accounts, because we found that there is a point where you need to say it enough. Because following up an account for one EMI and continuing to keeping it in 60 days delinquency doesn't make much sense, because a lot of labor goes in. So it was a deliberate attempt by the management that yes, we should try to knock off any asset which is showing a lot of resistance to regularize, or for that matter, the investment in terms of recovery is recovery efforts is much more. We are happy that we have been in a position to hold on in terms of gross NPA ratios at 0.46%. Net NPA, unlike previous years, we have not tried to provide full, because we are confident that by March it will be a much better quarter when it comes to Q4. Because there is one more reason why the NPA in terms of ratio, it appears to be more, because the growth rates, the normal usual growth rate is yet to return. I think the growth rate, we expect that coming to somewhere around Q1 of next year, I think things will be more than normal, and FY19 should be the best year as far as housing industry is concerned, not for Can Fin alone. There is sign of green shoots coming across the sector, almost in all the HFCs and the banks. There is a lot of competition. One more factor is there is a lot of competition in terms of the rate of interest. There is a rate war almost going on, because the banks are a big way into housing finance, and there is competition. Nobody should ignore that. That way, yes, the quarters have been quite tough quarters when it comes to the Q1, Q2, and Q3 of FY18. We hope that going forward, the way things are panning out, these are all positive only we see going ahead from now on. So Q4 should be, let us wish that FY18 brings in good luck and good opportunity for all of us, for the company as well as for all its stakeholders. Certainly, yes, we owe an answer to you for any of your queries and any of your doubts about the numbers if you have. We have tried to be as transparent and as open as we were earlier, so we have disclosed all the numbers in our presentation. That is why, along with this heavy format, we have uploaded the presentation immediately on all the exchanges, both the exchanges. I suppose I need not talk more about the numbers. I'll be, me and my CFO, all of us, both of us are there. We'll be more than happy to take your questions if you have got anything beyond these numbers or about the numbers, how it happened and what could not happen. Thank you. We'll be taking the questions now.
Thank you very much, sir. Ladies and gentlemen, we will now begin with the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. We take the first question from the line of Augusta Dave from CAO Capital. Please go ahead.
Thank you for the opportunity, sir. Sir, can you take us through the slide 11 and 12 and your commentary on what happened in October, because there was a pretty steep degrowth YOY, and you have then recovered very smartly. And December seemed to be a very nice month. So, if any qualitative commentary there, and how is January panning out so far? My second question is on rights issue, sir. Because the growth has been lower this year, your capital adequacy has actually improved. My guess is that is kind of putting pressure on NIMs also in a way. So are you planning on going ahead with the rights issue even now? Because you have maintained that 2019 and 2020 will be the best years for the industry. Thank you, sir.
Yeah, thank you, sir. It's a nice question. I was expecting, while putting these numbers on the board, certainly there is nothing to conceal. I have got an answer to that, and there is a very, very valid answer. This time, if you remember, unlike earlier years, I think 2017 was the first year when the Puja holidays came in September end. And the Diwali was somewhere in the mid of October. It was not like the usual years when the October used to witness Dasara and Diwali towards October end and November first week. So October is a month of 31 days. If you see practically the working days was something around 20-21 days only. And that is one of the reasons, because normally post a quarter end, 1 or 2 days there will be some till such time that the people start again or holiday season leading to, if you see the September number, you will find the answer there. September number was very good. One of the reasons may be because the puja was advanced. So people do these jobs, mostly they are buying a home or looking for a house or going for a loan before that. After that, normally what happens is, because as Canfin deals mostly with salaried class, people will be in a holiday mood, and that is the time that normally we don't see much business during puja holidays. That is the reason. Otherwise, I don't see, if you see the quarter as a whole, I don't see any slump, because compared to Q1, if you see the Q2 and going forward, if you see, that is why we have embedded a trend line as well. You can see that the monthly sanctions, approvals have risen to something like around 500-550 crores a month, and the disbursements are in the range of 450 to 475 crores in a month. So going forward, Q4 certainly, as the trend says, it should be somewhere in the range of 600 crore a month in Q4, 600 crore plus in Q4 as far as new approvals are concerned, and disbursements should be in the range of 500 plus average.
Okay.
Yeah.
And so January is panning out well, sir, basically.
So you can always see that. Let's not see, because many times what happens is a particular month, you see the growth rate will be very good in Q4. Very reason being the Q4 of last year was a subdued quarter.
Correct.
Because it was immediately post demonetization.
Correct.
Yeah. So that way, it is pure arithmetic. That is what somebody was asking me. One of the anchors, somebody asked in one TV channel that how come this growth rates are looking like 19%? It is going down. It is pure arithmetic. Arithmetically, it is always true that when the base figure is a good figure, it was a pre-RERA, pre-demonetization and pre-GST period. I am comparing something which is a suffered year with a normal year.
Correct, sir. Correct. I agree, sir.
I suppose next year people will be asking me the same question. How come your growth rate is spiked?
Yeah.
So this is pure arithmetic. As far as we need to see, that is why we have given month-on-month trend. You can see the average, whether averages are improving or not.
And sir, about rights issue, sir?
About rights issue, sir, I stand on to the company's this one, that when we came with the rights issue, the permission from the board, and we declared that we are thinking of raising 1,000 crore. We hold on to our that stand, and we have not dumped it as of now, because going forward, company doesn't require for capital adequacy. My capital adequacy is strong enough.
For the liquidity.
We want it for the leverage. Yeah.
Yes.
We want it for a sound leverage. So that the company holds as of now. But there are some issues that, yes, we have kept it deferred. Maybe at the right time, opportune time, looking at the valuations and looking at once the growth returns, we should be there in the market with the issue. It stands, sir.
It stands, sir. Thank you very much, sir. Good luck, sir. I'll see you again, I guess, if I get the turn. Thank you, sir.
Yeah, sure, sir. Welcome.
Thank you. Next question is from the line of Nischint Chawate from Kotak Securities. Please go ahead.
Yeah, hi. So this is pertaining to the breakup of your loan book, and very interestingly, over the last 4 quarters, the share of salaried customers has actually gone down from 77 to 74. I would have typically assumed that, given demon, etc., you would have possibly seen the share. I mean, you should have possibly seen the share of salaried customers going up, but things the ratio seems to be the other way around. So I was just wondering how to read this.
Yeah, for the 4 quarters, if you see, it has gone down from 75 to 74. Not exactly 77. My slide number 16, you can see, sir, the salaried class comes in the first, this one. In percentage terms, it has gone down from 75 to 74. The previous year, it was 80%. That way, if you compare, yes, the company is, we have remained the darling of salaried class, but we do, and we are looking into this SENP segment as well. The very reason being, this is a promising sector, and this segment of customers you cannot ignore because their number is increasing very fast. And the aspirations of the youngsters when it comes to the SENP segment, you cannot ignore. That's a very good the potential segment that yes, company needs to increase its student. So we are increasing. But when it comes to why salaried space is reducing, there is one more reason. Post demonetization and post RERA, the salaried class are more informed, having access to information where what happens, particularly in a state where you don't have many RERA compliant properties, they are willing to wait. They are not in a hurry. They always defer their decisions that unless they check and confirm that this property is complied with RERA, they'll go for it. Recently, if you have seen, there are 700 and odd properties, the projects in Bangalore were issued notices by the RERA of Karnataka that they have not registered with RERA. So naturally, people will go jittery. Those who are buying a property in those particular projects will think twice. So what happens is, salaried class being more informed, they always tend to evaluate and wait till such time they clarify their doubts. So clarity of RERA, clarity regarding the RERA compliant project and the supply side, I suppose it will take little more time. We can expect that we are thinking that Q3, Q4 should be good quarters, but somehow in all the states it was not that uniform. We see a very good growth in those states where RERA was stabilized.
So broadly, I think what we can say is that if you have seen any kind of soft growth over the last 2 quarters, I mean most of it could be because of RERA than really anything else to do with demon or anything of that sort.
Demon is far behind now. Demon has rather, I always stand by my words, earlier also I have told, demon was something which was very good to happen for the sector, because particularly for my clients, the type of clients that Canfin caters to, they are mostly middle class, lower middle class, and the LIG segment of customers who are in the income range of a lakh and below a month. So these sort of people, this particular segment of customers, normally a housing loan is maybe the biggest loan in their life, and the right side of the deduction side of their pay slip, this the housing loan EMI will be the biggest deduction. So they are very, very careful about before jumping into deciding on a property. Even for when they go for buying a car, these guys don't upgrade their car also in so frequently. So when it comes to buying a home, naturally people do all the due diligence much better than the financier. This is how really the human psychology works.
Sure. So just on the CLSS scheme, how much subsidy would you have applied and how much would you have received from the government, from NHB?
CLSS, sir, yes, we have got fairly good number of loans, particularly under LIG. MIG is picking up now, and as far as the disbursement of subsidy is concerned, it's not an issue. Normally the subsidies, wherever they are conforming to because there is a conformation to the Aadhaar, and the family should not have revealed anything. It should be the first home, and one is the carpet area. To the extent of carpet area, it is on affidavit basis people are doing. But many of the earlier carpet area norm, if you go by, many of the existing properties were not qualifying. So the CLSS, I think the real CLSS uptake you will get to see in 2019, FY19.
And any numbers you could share as to how much subsidy have you claimed?
I don't have the exact numbers, but it is quite a sizable number.
Okay.
Can you tell the number? Number you can suggest if you can. Okay.
Okay, sir. Thank you very much.
Right, sir. Now, if we get the numbers, I think we'll like to give a supplement somewhere we'll upload.
Sure. That would be great, sir. Thank you.
Thank you. We take the next question from the line of Megha Shah from Future Generali. Please go ahead.
Good evening, sir. Congratulations for the good set of results.
Thank you.
My first question would be pertaining to your borrowing mix. Now that we see your current market borrowing stand at 58%, and with the rising bond yield scenario, your bank borrowings are 22%. So how do you see your mix moving going forward? I mean, how are you going to protect your cost of funds from rising, given that you have a high exposure to the NCD markets?
It's a good question, ma'am, but if I got a high exposure to the NCDs, as of now, I stand protected to that extent. That is, for the next few years that I have logged in those borrowings for a longer term, because the money market borrowing also, if you see, most of our market borrowings are in terms of NCDs. CPs we restricted to maximum over 1 year inflow. So we don't have much short-term borrowings. These are mostly long-term borrowing.
No.
To that extent, we are protected. We stand protected because we have borrowed before the bond market started moving upward. That is one. Another thing is, even though our borrowings from banks is at around 22%, we have enough credit line and reasonably good rates. Plus, there is a NHB borrowing which is again available to us. The line is available to us.
Okay.
We are comfortable with it will not be an issue for the amount of growth that we envisage.
Okay, and what are your incremental cost of funds and yields, if you can tell us?
Incremental cost and yield, I can say you one thing only, you will have to do a little workout only. Because my cost of funds as at March was something like 8.35, now it is 7.72. And yield was 10.96, right now it is 10.39.
I'm talking about the current loans in the month of Jan. I mean, what are the incremental cost of funds that are...
That's what I'm telling. If I'm giving you the March numbers and current numbers, loan books are there, I think we'll have to do some working and I'll have to tell you.
Sure, sir.
You can work out.
Okay, and so you were expecting your margins to be maintained going forward, given that you're well protected on your cost of funds side. Although yields are seeing a bit of pressure, but you feel the margins would be somewhere around this range?
Yeah, yields are an issue, not the cost that much, because cost, I suppose these are manageable as far as the company is concerned. Going forward, yields, if you have to compete with the market, then you need to keep your yield somewhere par with the banks. And now competition is not amongst SFCs alone. Because if you see the worst of the bank who are under PCA, their cost of funds is also sub-6. Because there is huge amount of money stashed in CASA. And the banks are in a position to afford because of the very low cost of funds. There is a pressure from yield side. And there is a lot of, if you want to protect your loan book, you need to take that pressure on your yield. That is a known casualty that all the SFCs have to go through.
Your cost of funds would commensurately come down? Is that what you're saying? So that your NIMs are maintained, your spreads are maintained?
Let's see, there are ways, because if you have to manage your yield, and if the costs are maintained, then to manage your yield, you have got other ways that you can change your mix.
Okay.
So we are looking at going for some high cost as well. So that another thing is Canfin has got a risk-based pricing, so we don't offer the same rate to all the guys. Somewhere we need to, management has got many tools to really handle the yield that way. We are deploying all those resources, let's see.
And one other query, sir. Your non-salary portion is increasing, right? So does that come in with a higher yield or how does it work?
Yeah, it comes with a little higher yield.
Little higher yield.
Okay. That is where I told you the mix also is going to play.
Right, that's how you will alter the mix is what you're saying. So what is the target self-employed that you're planning to have in your loan mix?
I'm not precisely decided. We will see that within a tolerable range, because primarily we deal with the salaried class, but non-salaried class, yes, there is a stringent due diligence process. So that is how, if for underwriting a salaried class, we take less than a week. For a salaried class, we take more than around 10 days or 2 weeks time. But still then, not only non-salaried, there is a non-housing portfolio. We do only 10%. 10% is our exposure to non-housing. That offers some opportunity.
Okay, so I just want to understand what are the targets that you would want to achieve in terms of non-housing also. How much would you get to? You must be having a threshold target kind of a thing in place. So would it be somewhere around 15-20% or anything that you can guide us with?
I can say this much that yes, because right now the pressure of the entire focus is on housing. As far as the government's move, the housing for all is concerned. So non-housing is not in the focus area. So deliberately the company needs to maintain the right mix if we have to sustain our health. That's all I can say. Yeah.
Oh, okay, sir. Thank you.
There is no limit. The limit of non-housing is we can go up to 49%. As of now, 25% was the earlier untold limit. But I suppose now the HFCs can go up to 49%.
Okay, sir. Thank you so much for that valuable feedback and insights.
Welcome.
That's all from my side.
Thank you. We take the next question from the line of Harshit Toshniwal from Jefferies. Please go ahead.
Hi, sir. Wanted to know that if you can throw some light on the regional dispersal growth and the general trend. So more specifically in Tamil Nadu and Bangalore also, I think there was some registration issues. So can you throw some light on how things are there on the field?
Bangalore doesn't have registration issues. Chennai have got those registration issues because there was a High Court embargo on the primary.
Right, that was there.
Yeah, that was there last year. Things are yet to be, but secondary sales have started there, and we are funding mostly for the construction cases. Somebody owns a piece of land. So Chennai is looking up. As far as Tamil Nadu market is concerned, it is looking up, but not at par with the Can Fin's growth rate. And as you know, almost a third of our business comes from Karnataka, and almost 15% comes from Tamil Nadu. So it is almost half of the portfolio comes from these two states. And Karnataka, there was some delay in terms of the RERA, and because the people are well informed down south, normally what happens is the demand doesn't go anywhere, demand remains. Maybe it's a deferred, the demand will manifest in terms of the loan book and the inquiries going forward in the coming quarters. But certainly, yes, the growth rate in these two states are in comparatively much lower. And if you reduce these two states, even if you reduce only the Karnataka alone, you can take that the growth rate elsewhere is something like in the range of 6-7% higher.
Okay.
Yeah.
Okay, and sir, what is the difference between, so for you, the yields between self-employed and salaried class?
It is something in the range of 50 basis points, 35 to 50 basis points.
35 to 50 basis points. Okay. Okay, sir. Thanks a lot. Thanks.
Right.
Thank you. We take the next question from the line of Ritika Dua from Elara Capital. Please go ahead.
Yeah, sir, thank you for taking my question. Just one question. So we've been, our operating efficiency is like obviously, despite the growth slowing down a bit, we've had a very tight leash on OPEX. And, specifically if I see the staff costs, they've risen just by like a 10% on a YOY basis, 10 to 11%. So what has led to this and how? And secondly, we've mentioned now that in our presentation that we would be incrementally opening some branches and then again converting some into our affordable housing centers. So in the light of these two, sir, how do you see costs incrementally?
As far as the efficiency part is concerned, yes, it manifests in our cost-income ratio. We have been, the year through, we have been in a position to hold it around 14.5% compared to almost it was 2.5% higher even last year. And in the previous year, and if you see, there is a consistent drop in our cost-income ratio, which shows the operating efficiency of the company. Costs, we have been in a position to control. Staff cost, yes, staff cost, even though there is a drop in terms of the quantum, if you see, there is a jump. Where we are getting the benefit is you need to look at the average business per branch and average business per employee. Now the average business per employee has gone to something like 24 crore and average business per branch something like 107 crore. So these are good numbers. This is really helping us because we have been in a position to, as the employees mature, as the branches mature, the productivity improves and you tend to generate per employee and per branch, you leverage these outputs and that way the productivity. And that is how the operating efficiency we have been in a position to hold on to. I think that is one of the reasons that despite a 16% growth in my NII, we are in a position to post a PAT of 36%, 34% growth. I think that is the key for campaign.
Sure, sir.
Yeah.
So, sir, incrementally, anything on cost to income you want to help with?
Cost to income, incrementally, when we are opening these branches, 20 branches, we had plans to convert 30 satellite offices to affordable housing loan centers. We have already done 20. The remaining 10 we are planning. Some of the branches which are not giving good numbers, some satellite offices, we have preferred to close down those or to relocate few. New branch opening, we have been little careful. We are going into the growth centers. Wherever growth is, we are opening those branches. Otherwise, we are not opening branches just for the sake of increasing the network. As growth returns, we are willing to go to expand the network in a bigger way again. As far as the employees are concerned, I suppose I had told earlier, we have tried to bring in more number of professionals into the company in terms of the advocates, the chartered accountants, the company secretary, the law officers, the MBA graduates, management trainees. So we are trying to bring in specializations, the people with those special skills into the company so that you can leverage on their the talent and the succession pipeline is maintained.
Certainly, sir. So thank you so much, sir. That's it from my side.
Thank you. We take the next question from the line of Sanket Chheda from IDFC Securities. Please go ahead.
Hello.
Hi, sir.
Yes, sir. As you just mentioned that you're witnessing pressure on yields mainly because of the salary segment is little more informed compared to others. So would that be also the case that banks are going really aggressive and other NBFCs also offering rates around 8.5 to 9%. So they are shifting there or they are taking out the customers because banks should be quite comfortable doing salaried segment rather than going for self-employed. So are you witnessing that trend?
I don't see really the flight of loans as far as the shifting of loans to your loan book to other banks is concerned. I don't see that much really on account of whether it is in salaried space or a CNP space. What I told is salaried space are being more informed, therefore their decisions of buying a home. So that is why the salaried space is not increasing, our loan book to salaried space is not increasing that very fast because you can take it as something which is a demand which is deferred. So the buyings are going to come. The demand is not going out of the market. It remains there. Only thing is you may witness as clarity regarding RERA, some clarity regarding the GST and all those things are emerging. Maybe you will find as the supply side is getting addressed now, a lot of buying and lot of demand from the salaried space going forward in the coming quarters. Because being well informed, normally what happens is they always evaluate whether to go for it now or to wait for the next quarter, wait for some right time. I gave you the example of the RERA non-compliant some properties in Bangalore for which the authority has notified 700 and odd properties. So the people who have got access to information, normally what happens is they don't want to put in their hard money into buying a home when you can very well manage in a rented accommodation till such time that you are confident about the home you are buying, whether it is RERA compliant or not, whether even if when people expect that there is some price correction expected, they are willing to wait. This is what happens in the salaried space, how the psychology works. As far as the competition part is concerned, competition is there for rate. Because a bank offering 8.25, 8.35% rate of interest, there is a margin of 2.35. Whereas for me, it is not so. My cost of fund is 7.72. And when I offer 8.5 or 9%, still then my margin is much minimal. So what happens is I make money through my asset quality, through the operating efficiency, not through the spread really. So 3.5% margin, there are many of my peers who make 4% plus margins, but Can Fin has remained always comfortable around this range. We are posting the same numbers. Very reason being, the Can Fin's fundamentals are, the company has been grown that way. We have never deviated from our fundamentals. That when growth is not there in the market, if the growth is slowed down, we know that yes, Karnataka market or Tamil Nadu market is not growing at those pace what they used to earlier. So we are willing to wait for those growth to come rather than growing at any cost and compromise with the quality.
And sir, are you witnessing any trend like if a customer wants a top up or something for like say home renovation, so if we are not comfortable on the basis of LTV, somebody else is giving them the top up and at a comparable rates, are you seeing those kind of customer acquisitions by some other firms?
These things are there. Even earlier they were there, even now it is there. That will be there always in the market. But as a company, we never believe in really allowing people to get inside Can Fin through that route. If somebody is going out, still then we see that yes, the pressure on our loan book is not that much because we maintain a comfortable LTV. So if any of my customers requires a top up any point in time, if it is a genuine requirement, we are there to help. But if somebody wants unethical, we never mind if he's switching.
No, what I wanted to know is are the LTVs are getting diluted at a systemic level? You see LTVs are getting maximized or optimized.
I suppose going forward, let's see. We need to, in such a situation, I won't give an answer on the market, but one thing I will tell is, these are high time really when you are flush with liquidity, how tight you are on your purse, that only depends that how far you are going to go in the long run. So one should not be tempted by this sort of growth. That's what I'm telling. For the growth sake, if I want to hold on to the growth rate of Can Fin that used to be 25-30%, we are not willing to grow at those rates when there is no growth, genuine growth in the market. We are willing to wait. When the growth comes, the company should be ready to capture those growth. We will not compromise with our fundamentals.
Okay. Okay, sir. That's all from me. Thank you.
Okay.
Thank you. Next question is from the line of Janvi Goradia from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi sir.
Hello, ma'am.
So in terms of our net NPA, which stands at about 38 crores this quarter as compared to, say, roughly 2 crores on a YOY basis. So what's your sense on the PCR? I mean, do you think you will, as our company has been going to a net NPA of 0% by March and since last several years, you think you will make that much of a provision in Q4 so that net gets 0, or you'll keep the PCR at less than 100%?
Ma'am, one more thing I would like to ask you. I told you in the beginning itself in my opening call that in the Q1 we had allowed 180, we had marked almost 180 accounts as NPA and proceeded with surfacing. Out of those, and Q2 some, for the 3 quarters, almost 350 plus accounts amounting to around 50 crores we have marked for recovery, and we have invoked surfacing exam. Out of that, almost 170 accounts we have regularized. The very reason being, we are not worried about this 23.75 that I'll have to provide, and I require 23.75 crore to make, 37.51 crore to make it nil net NPA. We are hopeful that yes, we have been recovering, we are confident, we should be in a position to recover the substantial amount out of this. And normally, by the year end, Q4 always used to be a very good year. So we are not looking at last year if I was maintaining 2 crore of net NPA and I had provided 95% of my NPAs under coverage, and current year my coverage is 60%. Not looking at those numbers, really we are not worried whether it is, the quantum doesn't worry us much as long as we are in control of those numbers. 37.51 crore of net NPA actuals if you see for current year. There is not much of increment. If you see quarter on which itself was something like 24 crore, then 26 crore in Q2. This quarter again furthermore around 10 crore we have marked. Certainly we are confident that is why we are doing. We expect substantial amount of reduction by way of cash recovery. We should be in a position to upgrade those or knock off those from our book. If an account is warranting lot of your reports every month on month to collect one EMI or two EMIs, it is worth it to knock off those accounts from the book, because the cost that you incur in realizing those EMIs is much more compared to holding that account. So holding cost is much higher in the few of the accounts. That is where we take a call whether to allow this account to continue in our books and hold it, keep on maintaining your gross NPA at those levels or net NPA at those levels. These are all quarter end issues. I suppose the year end should be a good year end.
Sure, sir. Thank you so much, sir, and good luck.
Welcome, ma'am.
Thank you. We take the next question from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Sir, thanks for the opportunity. Sir, like a couple of quarters ago, you had indicated that we would be doing risk-based repricing of some of the loans. So just wanted to understand, like, what percentage of our portfolio has already seen at least one round of repricing based on the, and what was the quantum of reduction in yields that we have seen in that?
I don't have the precise number of that, but it is happening every month. It is happening every month when the customers, because we keep notifying them. It is there in our website. We do keep them informing through SMSs as well as whenever they are approaching the branch. So it happens. It is an ongoing process.
And this is started on 1st of April 2017, right?
Pardon, sir? Yeah, from April onwards. For current year, FY18 itself, we had from April onwards we started this, and we have taken the annual resetting we are offering to the customers. And Canfin is the first housing finance company which has been so transparent with the borrowers. What we are telling them is, yes, if you switch over to the annual repricing mode, then once you reduce by paying the interest adjustment charge, subsequently it will be auto reset at the year end.
But sir, any ballpark number, like what percentage would have migrated to this 15, 20, 30% of the borrowers?
I don't want to put anything guess because I don't have the numbers right now with me.
And so, like, what would be our GNPA absolute amount in, say, the salaried and the non-salaried segment? If you could share that bifurcation.
I suppose I'll have to do some more research and dig into those numbers. But I have not seen any difference in delinquency in terms of salaried and non-salaried.
And so in this particular quarter, the slippage that came, any color on that? Like, was it from salaried or was it again split?
No, that's what. This has been a common question. I think in my previous quarter end calls also, you will find that, yes, I have clarified. There is no specific trend we have seen that the salaried used to tend to default more or the non-salaried used to default more. It depends on a particular individual only. You cannot give a color whether salaried or non-salaried, which particular segment of customers tend to default more.
Okay. And so, like, what would be the total outstanding approvals wherein the borrowers may come ahead and approach for further disbursement, and that bifurcation into, say, like where the property is not identified or where there's some part disbursement that has already been done. So just wanted to get a sense on the outstanding approvals where we may expect some disbursement in case the disbursement pipeline, which will add to the disbursement pipeline of the future quarters.
No, always the disbursement pipelines, it starts from the approvals.
Right. So what would be outstanding unavailed approvals that we have right now on our books?
Always you can take it that any point in time you will have of your sanctions, the disbursements will be something in the range of 80-85%, and the disbursement, the outstanding will be, because we are an old housing finance company, we are a 30-year-old housing finance company. If we are new, particularly in my new branches, what happens is they disburse 10 crores and the outstanding goes up by 11 crores because the last year's interest accrual will be there plus this 10 crore full. Because EMI will commence only after the moratorium period is over. But for an old company like ours, because we have got branches, individual branches holding a portfolio of 500, 600 crore. I got many branches with close to 500 crore of outstanding loan book. So there will be old customers who tend to, because the usual repayment itself is substantial enough for Canfin. That is a good chunk, because 40 branches are old branches. Remaining branches have come up in last 5 years. So that is where the churning of the portfolio, it keeps on happening.
Okay.
So you can always see that the incremental per quarter, if you see the increment in terms of what's that, your sanction, disbursement and outstanding, you can see a pattern. Normally, if it is almost 550 crore a month in terms of sanction every month, disbursement will be in the range of 450 crore and the outstanding will go up by something like maybe 200, 250 crores. In between there will be a repayment, there will be some prepayments, and even though you sanction a housing loan for 30 years or 25 years, the usual tenor is something like max 15 to 18 years. People do tend to prepay and upgrade, take another loan. So in Canfin, we see a lot of our old customers coming back for fresh loans, or the father had taken a loan, the son is coming for a loan. That relationship works for Canfin. That is our strength.
Okay. Actually, what will be the average incremental ticket size in the home loan disbursement that we do in the non-Tier 1 locations or the non-metro locations?
Non-metro locations, it will be in the range of 10 to 12 lakhs. In the metro, it will be in the range of something like 25, 30, 35 lakhs. That will be the average. That is how the average works out to something like 18 lakhs. It has gone up really for this financial year by some 18 point, marginally higher. It is 18.16 lakhs precisely for the average ticket size of housing. Non-housing, it used to be something like in the range of 10 lakhs. It has come down to 8.9 lakhs.
And lastly, what would be the employee attrition rate that we would be seeing?
It's almost negligible.
Negligible. Okay. Thanks a lot, sir.
Thank you. We take the next question from the line of Bunty Chawla from B&K Securities. Please go ahead.
Thank you, sir, for giving this opportunity. You have revised the FY18 number to 16,000 crores, right?
Yeah.
So can you give the same number for FY19? Is it possible?
I suppose before the Q4 end, I will give you this number. Or when I come for the Q4 numbers, I will be giving that.
Okay, or something like that ballpark figure means kind of a growth which you are expecting better than the FY18 for FY19? Because what we are observing, the currently HFCs, mid-cap HFCs are facing the competition from PSU banks, which is in this in your case also. And next year they will be getting the recap bonds. So this competition might increase in that favor. So can you throw some light on that?
So there are two aspects to it. One is the competition from banks, and with recap bonds, yes, banks will be having enough. As of now, liquidity is good enough for all the banks. Cost of funds are fair enough to really lend at very competitive rates. But going forward, what happens is the housing finance companies, they will continue to have their space. There will be customers who will be always willing to come to the HFCs. How we attract the borrowers?
Right.
It's something like this. I stand by the one example, primarily I used to draw every point in time. That for a bank, housing loan is one of the many other products. So right. You think of even a housing loan borrower who is availing a loan of 75 lakhs or 80 lakhs or a crore rupees from a bank's branch. How much importance he will get in the bank's premises? And a guy who avails a 25 lakh housing loan in Canfin counter, how much importance? He is a big customer for me. So the amount of attention that he receives in a housing finance company is much higher. That is where people really tend to enter a housing finance company. Otherwise, always if money only matters, if only the EMI amount matters, I think only the bank having the lowest rate on its card should take away entire portfolio. And we should not be doing business. If right. Even today I continue to do business at 19%, and if my new approvals are going on increasing at a pace of 14-15%, then I suppose there are people who still like Canfin.
Sorry. One more thing on the data.
We need to wait that yes, how long and how far really going by the demand that exists. and the number of houses those are to be built and funded.
Right.
I suppose the banks should have come in earlier, and you require really many more players. Maybe we need to, as a company, that is why going by my average ticket size, we stick on to our niche area where the bankers may not be interested that much. Because they cannot handle this portfolio. If I am having a portfolio of 15,000 crore, it comprises of 1.25 lakh customers.
Right.
Yeah. So these numbers are not possible to handle from a bank's counter. Even when me being a banker, I can say that yes, what is the importance we used to give to an individual home loan buyer? How much time I can assign to him? When I have got many SME clients, ME clients and corporate clients to cater to.
Right. Sir, on the data per se, we have observed the prepayments were around 500, 600 kind of a run rate we were observing in FY17. This quarter, if you see, it's almost touched more than 700 crores of prepayments. So can we assume this kind of run rate to continue, or still it could be lower or it could be higher?
Now, is it prepayment or is it repayment?
It's means we generally calculate by subtracting from the disbursement.
The outstanding increase.
Yes.
Correct.
Yes.
That's where I told. We need to calculate when it comes to a old housing finance company, the arithmetic has to go this way. There was an existing portfolio. How much is the 5-year-old or 3-year-old portfolio? On that, you need to load a percentage as routine EMI. I have got a repayment cycle on 5th, 10th, 15th, 20th. Normally, my repayment cycles of 10th and 15th will comprise of something like 40 to 50 crores which comes through ECS and NATS.
Yes.
So that is the usual repayment. Those are not prepayments.
Okay.
So that will always be there, sir.
Okay. Lastly, on the during this quarter, we observed there has been a decline in the tax rate. Are we getting any benefit, or can you highlight what will be the effective tax rate for the full year?
That is, earlier we used to take the benefit only on the write-offs. Now we are getting the benefit on provisions.
Okay.
But what happens is, if you see my provision, it comes on the 5% of taxable income, and the amount I have provided current year, it has really exceeded. So my provisions are, that may be one of the reasons as well that your provision planning has to be accordingly.
Okay, so can you just guide on the full year tax rate, effective tax rate for FY18? Is it possible?
It is only, instead of you are getting the benefits earlier on your write-offs only, now you are getting directly on the provision made during, incremental provision made during the year.
Okay.
That is it. So the effective tax rate will come down to something like 27.5 or 28%.
Okay.
From 33.5, 33, yeah.
Okay. Thank you very much, sir.
Right, sir.
Thank you. We take the next question from the line of Hardik Soda from Asian Market Securities. Please go ahead.
Hi, sir.
Hello, sir.
Hi. Sir, can you give me the breakup of loan into the categories of less than 5 lakh, 5 to 10 lakhs and above 5 lakhs and the respective GNPA for each category?
I can give you the breakup of my ticket size. GNPA in those categories I am not giving.
Okay, sir.
This percentage is majority of the percentage wise, the major chunk, almost 50% will be in the range of 5 to 25, 30 lakhs, in that range.
Okay.
That much I can say, yeah.
Okay, sir. Thank you.
Less than 5 lakhs, we don't have much other than the non-housing loan. Somebody wants a personal loan or something like this. Otherwise, in housing, individual housing, it is not much.
Okay, sir. Okay. So, and
more than a crore, I have got precisely 53 accounts on my loan book.
Okay.
All loans put together.
Okay, sir. Sir, my next question is, sir, in Q2 we had around 177 branches and in Q3 we had 172. So was there any particular reason for the reduction of the branches?
It's not branches, it's all the outlets we had kept.
Yes, sir.
What we have done is, those satellite offices, we are holding around 50 satellite offices.
Okay.
Which are government branches. What we have done is, the satellite offices were opened in the upcountry locations to evaluate the potential of that area. Wherever we found that it can do good, we have upgraded those to affordable housing loan centers, and they are having full-fledged power with adequately manned to sanction loans and cater to that area themselves.
Okay.
Few of the places where we didn't find much of scope, we have closed down few of the satellite offices.
Okay, sir. Sir, my last question is, in a scenario where bond yields have hardened and incremental borrowing cost on rise, so how does Canfin plan to defend its name?
Yeah, this question, I suppose it was asked earlier. I'll say that if right now a sizable chunk of my borrowings are already from the NCDs, by way of NCDs and long-term borrowings from the banks.
Yes.
It stands protected as far as the term loans are concerned, the borrowings from NHB are concerned, or the NCDs are concerned. At least it's a lock for those 3 years, 39 months, or 5 years that it has been borrowed for.
Okay.
Bank loans will get repriced annually once based on the annual resetting. So for a longer tenure, yes, we are protected as far as the borrowings are concerned. As far as incremental borrowing is concerned, we have got adequate credit lines. Still, we continue to borrow below the market rates of the bond market. So we look at whether which one is comfortable and we go accordingly.
Okay, sir. And what kind of margin will be comfortable with?
The 3.5% margin, I suppose, if you are comfortable with, I am comfortable with that.
Okay, sir. Thank you, sir. This is from my side.
Right, sir. Thank you.
Thank you. We take the next question from the line of Madhuchanda De from Money Control Research. Please go ahead.
Yeah, hello. Hi. Yeah, my question is, you mentioned that you are not going to be taking any, aggressive step to increase the loan book when the environment is not right. So given that, much of this radar registrations are happening now, what is your take on FY19 loan book growth? Hello?
Ma'am, yeah, it's the right question. I told once earlier, I suppose. It's not that Canfin has lost its aggression or Mr. Hota has lost its aggression. It's not so. What we are telling is we don't want to deviate from the fundamentals of Canfin and run for growth. I suppose the management as well as the board has taken a considered decision that when growth is there, get growth. You should be always prepared to capture that growth. So that is where we have planned as far as our the rights issue we are thinking about, or the manpower, additional, incremental, whatever we required, we have inducted, converted all those satellite offices into affordable housing loan centers. So wherever growth is, we are willing to, and the company is poised to really capture those growth. Not that we are denying growth. Right now, the market that we operate in, particularly 50% of my loan book comes from Karnataka and Tamil Nadu. These places are witnessing a slowdown. Despite all those, if I continue to grow at 30%, I suppose there should be worry. So we are sticking on to our fundamentals. We will not compromise in terms of quality, but we are ready to capture that growth. And if you ask me about the outlook for FY19, we are yet to formalize on a number. That guidance I will give somewhere in the Q4 when end of Q4 we come with the numbers. Before that we will adopt a number and we will give. But certainly normal arithmetic says that I think it should be phenomenal growth going forward. The usual growth rate you will find, because you can always say that the old growth rates will come back, because FY18 has been a subdued year. First 3 quarters at least across the industry it has remained subdued, and as the RERA is getting stabilized, because we are witnessing huge growth particularly in those states where RERA has stabilized. That's what I told. If you exclude these 2 states, my growth rate, you can take it as it is. They are growing at something like 6 to 7% higher than the usual growth rate that we are posting for the company.
So if I may just, get a clarity on this. So are you kind of not putting a number, but basically are you looking to a better FY19 just because the base is better, because of the low base of FY18, or are you really seeing momentum on the ground?
Right now, momentum already, we are witnessing it. We are posting on our numbers, ma'am. Because I told, as far as the new approvals are concerned, Q1 I started with a flat quarter. My new approvals were same as the quarter 1 of FY17. Quarter 2, I posted a 4% growth both in terms of sanction as well as disbursement. Whereas quarter 3, I have posted a new approvals growth of 14% and disbursement growth of almost 9.5%. So already we are on the growth path. Going forward, we can say that, and this is despite, these growth rates are despite a sound, uninterrupted, unhindered base which was prevailing till Q3 of last year.
And just one last question. Are you seeing any kind of return of pricing power?
That will be there for all NBFCs, I suppose. Maybe now it is, as far as the cost part is concerned, we are not that worried, but yield part is concerned, yes, there is a pressure. So margins, holding on to the margins will be the biggest challenge for FY19 for all NBFCs.
Okay, thank you.
Thank you. Next question is from the line of Ronak Raichura from Asian Market Securities PMS. Please go ahead.
Hello.
Hi, sir.
Hello, hello, sir. Congratulations on a good set of numbers. Sir, my specific question to you is on the NIMs. Now, you said that you're not concerned on the cost of borrowings, but the NIMs you said are likely to be under pressure. My question is, does Canfin in its planning actually target a specific NIM? That is my first thing. And second is, sir, if I just think mathematically, if the loans currently which are priced in the range of 8.5% to 9%, okay, in terms of the yields, and about 90% of our book is actually into housing finance. Now, don't you think the NIMs are going to significantly contract unless we consciously change the composition of the book to a high-yielding things? Because while our current book NIMs are 10.39%, but if you see all the incremental disbursements are happening in the range of 8.5% to 9%. So these yields will soon catch up arithmetically, and therefore it will be really difficult to protect this NIMs. Am I right, or what's your take on this?
Yeah, arithmetically certainly you are right, sir. I don't have to contradict. Arithmetically it is so. If the incremental whatever portfolio we create carries a lesser yield, then naturally the yield will come under pressure. But simultaneously, if we are in a position to contain our costs, and if you want to hold on to your yields, the company needs to change its mix, and certainly the company is poised. And we have got our plans. That is why the madam asked that what sort of NIM margins you are comfortable with. We are comfortable around, we have been, even last year has witnessed so much of competition. The last first 3 quarters as well as the last year Q4 has witnessed so much of competition as far as the housing loan rates are concerned. We have got a risk-based pricing, whereas the banks don't have, except for barring, I suppose, very few, 1 or 2, that we know. Even at higher risk rates, we are in a position to fund. People are buying from home loans, they are taking from us. So we are looking at, there are few non-housing sectors where we can do. We are now that even the builder loan portfolio has it stands regulated, even that is one aspect we are looking into, but not that big way. We want to have a right mix, and we are focusing on non-housing as well.
Correct. So is there my point specifically is this, that does Canfin therefore say that, okay, I target a NIM of, let's say 3.5% or a spread of 2.7%, and then accordingly decide what should be my loan mix and then set targets? Does Canfin work this way, or how is it? Because so far these NIMs have been achieved on a housing book which is almost 89 to 90% of the total loan book. So
yeah, right now my housing loan is 90%, and it was almost around that over the years.
Right.
The non-housing loan book has remained around 10%, but still then we are in a position to hold on to those rates.
Right. So that's my point. So then now that
certainly, if the company was not having a department to plan the profits and the bottom line well, I suppose consistently almost for 7 quarters now that we are holding on to these margins. It would have been difficult.
Okay, great. So then we are having specific plans to increase our mix, to change our mix towards the high yielding to ensure that...
Changing the mix is one tool.
Yeah, so what other tools would be there?
That is one tool. There are many other tools that you can handle.
Could you elucidate some for the benefit?
Yeah, for example, going forward when the bond yields are increasing, what you envisage is the trend of rate of interest regime that is going to be there in the market. I'll ask a counter question first. And you think of if there is a repricing. Yeah, you need to pass on somewhere as much you can absorb, we absorb as a customer friendly institution.
So but you pass on the, so then you raise the yields on the housing loan is what you're saying, is that?
All the loans.
Yeah.
All the loans. You need to reprice your pricing, and the Canfin always follows a very methodical. That's what I'm telling. It is one of the first HFCs where we have got a risk-based pricing. So there is a risk premium and there is a profit margin which is loaded and then the pricing takes place.
Correct.
There is a very scientific pricing process. So certainly the company has got a very good profit planning mechanism in place, and we do things on a strategic level.
So then the counter effect of the rising yields could be also the increasing competition, because wouldn't that also increase? Maybe your repayment rates will actually increase because of. So you'll have to maintain that right mix of growth as well as margins.
Let's hope you need to. Yeah, that is where you are supposed to put me on test and ask me questions every quarter, and I'll keep on answering. As long as I'm holding on to these margins, I suppose you should give me some mark to my team.
Okay, sir. So my last question would be, sir, again on the NPA coverage ratio. You already covered. You said that you don't look at it at least on the quarter, but so just wanted to clarify that by the year end, you expect that most of the recoveries will happen, and if that does not happen, then you will to that extent provide fully the NPA, so that the net NPA on the year end basis will still be nil.
Let's see, sir, going forward, we will plan quarter on quarter. We will see the position. Our efforts are on. Let's see how it works.
Okay.
I'm confident that this is in manageable levels and it can be controlled.
No, that's fine. So if it, let's say that if there is...
Sir, one more thing. Last time somebody asked a question and I was asking on this one. 0.46% gross NPA means I give 1,000 loans and 4.6 loans go back.
Right.
I suppose this is one of the finest numbers in the industry.
Right.
Yeah. If we really put lot of pressure only on this, then I suppose we are discussing too much on the gross NPA. These numbers are fine as long as what happens is when we are working in thin spread, your margin comes mostly from the asset quality. So that is what has been the strength of Canfin, and your profits, it comes from a very good cost income ratio and the managed margins. If you can hold on to your margins, when my spread is not 3.5, whereas my margins is 3.58, my spread is 2.5.
Correct.
So with 2.6 spread, if I am managing a 3.5% margin, 3.6% margin, then certainly it comes because of the best, the very good asset quality and right borrowing at right time. And I already told you that the company has got the existing lot of high cost borrowings have been repriced, and these borrowings are locked for long term. So company is fairly protected from cost fund.
Right. Sir, one last question. Now, since you're saying that those two major states, Karnataka and Tamil Nadu, which is about 50% of the loan book, is actually slowing, versus the other states are actually showing much higher growth. So, so is it that our incremental branch additions will be more in the non-south based states? I mean, it will not be in these areas.
Yeah, the closures were there in some of the places where it was not growing really, and expansion. If you see the branch expansion of last 2 years, we have grown mostly in non-south region.
All right. So which region specifically are we seeing the good traction?
We have opened new branches in Kalyan, Boisar, that bit.
So using Maharashtra, the west.
We opened a branch in Surat. Okay. And then we have opened almost 3 branches in UP, 2, 3 in Rajasthan. Those are the Rajasthan, UP, MP.
No, that I understand. So, but the traction is coming most into which western or the northern region?
Sir, any state you pick where RERA is stabilized, they are growing faster. Okay. I can say openly. So, going forward, you can say that Karnataka and Tamil Nadu, not that they are slowing. They had slowed down, but now they are picking up. Okay. So, we are quite hopeful that if this my 50% starts delivering at the normal rate, it's a matter of time really. Now that RERA is stabilized almost, I suppose FY19 should be one of the best years really.
Okay. Thank you. That's it for me, sir. Thanks.
Right. Thank you.
Thank you. We take the next question from the line of Sangam Iyer from Shubham Ventures. Please go ahead.
Hello.
Hi, sir.
Hi, sir. Hota sir, just a couple of questions. One on the guided disbursement growth that we are talking about on a monthly run rate of 500 odd crores. Given the current repayment run rate that prepayment and repayment run rate that's going on, we would still be falling short of the 16,000 crore guided in the presentation. Can you throw some light on that, because mathematically we are falling short there?
Yeah, Sangam, I got your point. I got your point. I agree with you. Arithmetically, then you need to calculate. If we have projected 16,000 crore, how much I need to disburse and how much I need to sanction every month.
Yeah, so are we saying that our prepayment rate might come down? Because if that is the case...
No, that won't come down, sir. That will remain. Because at least the repayment won't come down. Repayment will be a regular phenomenon. It has to continue at that pace.
Now, the prepayment part, because of competition?
There is a portfolio. If my repayment comes down, I have got a bigger worry that my delinquencies will go up, my NPS will go up. I want my EPS and NAT to be honored by people. Let the repayment continue. I am willing to lend more. I see a traction. I see a positivity in terms of the new approvals and disbursements. I have got a lot of loans which are sanctioned yet to be disbursed. So we are making those calculations. That is how, if we revise from 17,000 to 16,000 crore and if we are given a number, I think we have done a research and we are telling it is doable.
Got it, sir. Sir, just going into FY19, when we are looking at because you give a very nice picture saying that FY19 would be one of the best years for the housing finance companies. What would be driving the growth here? Are we saying that the base effect of RERA would actually be a big telling factor, and also with RERA stabilizing, there would be a sharp uptake in most of the geographies where growth got offset because of the RERA stabilization? Is that one of the key factors which would drive the growth back?
Sir, the two key drivers will be, one is RERA stabilizing, because RERA brings in lot of the genuine home buyers confidence level in the property that he is investing in. So that is one thing. Another one is the supply side. Now that the carpet area norms for MIG is increased, the CLSS is going to play in a big way going forward in FY19. These two will be key drivers. One is CLSS, another one is RERA. Wherever RERA is stabilized, and the CLSS, now supply side issues are mostly addressed because the unsold inventories are brought into that CLSS range. Of course, Canfin is not into the MIG2 area, or even MIG1, we are not that big way into MIG1, that upper range. Because we cater to mostly the LIG and the MIG1, that's people who earn less than ₹1 lakh a month, in that range. Not people who earn up to 18 lakhs in a year, that MIG2 that falls into. So this side, sir, many big players are coming into the market, many big builders, they are coming into creating properties in this space because of the tax profits they enjoy.
Correct, sir. But
yes, sir, please.
Given that in MIG2 the ticket sizes are increasing, and that is where the competition also goes up with banks.
We are not into that segment. That's what I told. We are not into that segment. If we want to change our characteristic and want to, wherever our branches have tried to lend in that segment, that portfolio, it is difficult to hold on to.
Correct. So then how would you see CLSS being a big driving factor for us?
MIG1.
MIG1. Okay.
LIG. Because there is one more change recently. That CLSS was restricted to the notified townships. Now it is open.
Okay.
So that is another factor. So these two will be the key drivers. One will be the CLSS, which comes as an additional incentive for a home buyer to advance his decision and go for buying a house, owning a home. But these are for the individual first-time home loan buyers. This CLSS is only for individual first-time home loan buyer, not for the second house. Not for the second house. Let us wait for the budget is hardly few days ahead. I suppose there will be still some positive this one we are expecting. Because one is the properties for investment purpose we are doing because it was incentivized. That sort of sales are really, that has taken a beating. But as campaign is by and large, we deal only in the first time home loan buyers. Average age of my incremental borrowers is something sub 40. So we are not into that space, so we are not worried. But first time home loan buyers, they have got a big advantage. There is a big incentive for them if they are going for buying house. We expect that going forward that will be driving the growth. And certainly the best effect, FY18, a low base, low growth is going to add few percentage points in terms of the growth is concerned.
Right, sir. So, but do you think that then in FY20 only we would be going back to that, 30% plus kind of a growth rate? Or do you see that, in FY19 itself, that is something that will be achievable, given that things are coming back into the system?
Sir, I will ask one question. Growth rate is in terms of percentage. The growth rate has got its. I had a portfolio of 2,000 crore. I made it 4,000 crore. Growth is 100%.
Correct.
Whereas 2 years back we started March 16, we had a base of 10,600 crore. Now we have crossed 15,000 crore. It means in 1.5 years we have added something like, it is in 7 quarters we have added something like almost close to 4,500 crore. So if it is so, in a subdued year, if this is the growth, we need to compare the quantum always. This growth rate, you tell the growth rate, and I think that is doable going forward, leading to FY20.
Right. Because why I asked you this question is because when you said that growth per se, achieving growth is not the right way to look at it, but achieving a profitable growth is the right way to look at it. Given
yes.
Right. So that's why I wanted to understand, to gauge your confidence of whether FY19 is the right time to press the accelerator or FY20 is the right time to press the accelerator. Because you are more on the ground, so you would be understanding it better. That's why.
Sir, I suppose FY19 should be the takeoff phase and FY20 should be the peak phase.
Got it. And sir, on the margin front, given that, the two drivers that you mentioned earlier in the call, one was increasing the non-housing component and the second one being the non-salaried class as a percentage. I mean, these two would be the ones that would help us offset the competition and maintain the margins. Wouldn't the non-housing component, increase in the non-housing component, be a kind of a higher risk factor in the housing portfolio for us?
Not necessarily, as long as you keep away from those high risk without purpose loans. Non-housing loan is not all LAP. There is non-LAP, there are so many other sectors where the company has got a lot of scope to do something. That is one. Another thing is you need to lend into, as long as we stick on to our fundamentals, I suppose growth and margin should not be an issue. Somewhere if margin is thinning, you should be in a position to make good in terms of volumes. So there are many levers really the management can play with, and it's up to how best you can manage your bottom line. It depends on how best you can handle and the mix of your top line.
Got it. What's the difference between the yields in the non-housing component?
Non-housing component will have a yield of something like almost 12.5-13%, and housing will be in the range of around 9.5-10%, 9.75 to 10% in that range.
Okay, got it, sir.
Right, sir.
Great, sir. Thank you and all the best, sir.
Welcome.
Thank you. We take the next question from the line of Sangeeta Purushottam from Cogito Advisors. Please go ahead.
Yeah, thank you, sir. Actually, most of my questions have been answered. So all the best.
Thank you.
Thank you. Participants would like to ask questions. Please press star, then 1. Ladies and gentlemen, that was the last question. I would now like to hand the conference over to the management for closing comments.
Yeah, I appreciate Investec as well as all the investors who participated in the concall. There was a lot of insight that the management has to carry from you. Your concerns and your wishes, that will be the guiding factors for the company and the management. Certainly, I take always the concalls that what I clarify as far as the management's point of view is concerned between the numbers, whatever more we can disclose. More than that, there is always a takeaway for us. Thank you all. Wish you a very, very happy 2018. Let us hope that it is FY18 turns out to be the calendar year turns out to be a very good year for all of us. Thank you.